Welcome to the Deep Dive. Today we're digging into LGI Homes' second quarter 2025 earnings call. Our goal is to pull out the key numbers, figure out what management's thinking strategically, and see how the market took it all. Basically give you the full picture on this home builder.
Yeah, it's a really interesting time for builders, especially spec builders like LGI, how they're handling inventory, rates, demand. Well, it tells you a lot about their game plan. We should definitely zero in on those trade-offs they're making.
Absolutely. So let's jump right into the results because LGI Homes actually had a pretty strong Q2, even beat some estimates. They reported GAAP EPS of 1.36 cents, revenue at $483.5 million. But the thing that really caught my eye was the gross margin improvement. Sequentially, anyway.
That's a really key point. Yeah. GAAP gross margins got up to 22.9%, and the adjusted figure hit 25.5%. That's 190 basis points better than the last quarter, almost 2 full percent, right at the top end of what they guided for.
Wow.
It really shows some, tactical skill. They're defending profits, even with volumes maybe not being quite as strong.
Okay, so defending profits. They closed 1,323 homes, average price $365,446. And they were buying back stock too, right?
They were. Over 367,000 shares repurchased. That was $20.6 million.
And the market reaction, pretty immediate, pretty strong.
Oh, yeah. Stock shot up over 10% before the market opened, closed up 8.6% that day. Volume was double the average too. Definitely a sign investors liked what they heard initially.
Yeah, that surge wasn't just random noise. It felt like investors were saying, okay, we see you focusing on margins, on capital returns.
Exactly. Rewarding the focus on what they can control in this tricky market. But like you said, the real story is how they actually did it.
Right. So headline numbers looked okay, but revenue was actually down year over year, like almost 20%.
19.8%. Yeah, mostly because home closings dropped by 20.1%.
Though the average sales price did tick up just a tiny bit, 0.4%. Was that strategy or just, where they happened to sell?
Good question. It was mostly geographic mix, selling in maybe slightly higher priced areas, which helped a bit. But management was really clear. The big plan was protect margins, protect the balance sheet, let the sales volume kind of follow demand.
Right, adapt to the softer market.
It's not just adapting, though. It's like you said, surgical profitability. Very targeted.
Surgical profitability. I like that. So how did they pull off that surgery? They mentioned balancing financing incentives with price hikes in stronger areas.
Exactly. And they also mentioned getting extra profit from lots they developed themselves. That all added up to that 190 basis point jump in adjusted gross margin we talked about.
So smart tactics. Not just broad discounts.
Precisely. Use incentives where you have to, but lean on your strong spots, your land position, to keep profits up. Smart allocation. And meanwhile, SG&A costs, selling, general, admin, they came in at $71 million. That's 14.7% of revenue.
Okay.
And selling costs actually benefited because they spent their advertising money more efficiently. Ties back to that targeted approach again.
Makes sense. Focus the ad spend where it counts, especially when things are tight. And the bottom line impact. Pre-tax income was $42 million, so 8.7% of revenue. Net income, $31.5 million.
Yeah, with a 25% tax rate. So decent profitability, definitely, considering those revenue headwinds.
Okay, so that's the financial side. But what about operations? Inventory, how are they managing that?
Well, this is interesting. They actually grew their active community count, up 14% year over year to 146 communities.
More communities. But the absorption rate, sales per community, that softened quite a bit.
It did. Dropped to 3.0 sales per community per month, down from 4.3 last year.
And net orders were down from Q1, too, at 1,091. Shows that demand was, pretty sluggish for most of the quarter.
Definitely. More places to sell, but slower sales at each place. It's a balancing act.
And that slow demand probably feeds into the cancellation rate, too.
Absolutely. It jumped up to 32.7%. Last year, it was 22.2%.
Ouch.
Now, part of that big jump was a specific thing. They canceled a large wholesale contract that they'd booked back in Q1.
Ah, okay. So a one-off factor there.
Yeah. But even so, the wholesale channel itself was pretty important this quarter. Wholesale closings were nearly 18% of the total.
Up from about 7% last year.
Right. Management called it a compelling way to balance completed home inventory.
Okay, using wholesale to move inventory. But with that high cancellation rate, is that really a net positive or just a short-term fix?
That's a fair question. It moves houses, sure, helps the inventory situation quickly, but typically you get lower margins on wholesale deals compared to selling directly to a buyer. So it's a tool they have, but they need to use it carefully. It's a trade-off.
Right. So where did that leave their backlog and inventory at the end of Q2?
Backlog was 808 homes, worth about $322.5 million. But the completed inventory, that's the number that stood out.
How many?
Around 2,300 finished homes sitting there. And they admitted, yeah, that's more than typically carried given our order pace.
Okay, so too much finished inventory. What's the plan?
Focus hard on selling what's already built. That means increased incentives on older inventory.
So deeper discounts potentially on the houses that have been sitting longer.
Could be. And they're also going to pull back significantly on starting new homes for a bit. The target is to get back down to about 6 to 7 months supply of inventory.
6 to 7 months. Sounds like a reasonable target, but getting there without missing sales if demand picks up or getting stuck with even more, that's tricky.
It's a very delicate balance, yeah.
Yeah.
Trying to guess future demand while clearing out what you have now.
But their land position helps here, right? They have a lot of lots.
Huge help. 64,756 owned and controlled lots. That gives them, as they put it, multi-year build optionality.
Meaning they don't have to rush out and buy land right now when things are uncertain?
Exactly. It gives them breathing room, flexibility, a big advantage for controlling costs down the road.
Okay, flexibility. And something else they stressed was affordability. A laser focus on it, they said. Why is that so critical for LGI specifically?
Well, their main customer base is entry-level buyers, and that group is, super sensitive to mortgage rates and economic worries.
So affordability is everything for them.
Pretty much. So their strategies aren't just about temporary fixes like rate buy-downs or incentives, although they are doing that.
Being flexible on price too, I imagine.
Yeah, where they can. It connects back to that surgical profitability idea, adjust pricing where needed, but hold firm elsewhere.
But they're also thinking longer term on affordability, aren't they? Product innovation.
Yes, exactly. Looking at maybe smaller square footage homes.
Yeah.
Considering more attached housing, like townhomes, and even optimizing how they develop land, smaller lots maybe, to get the finished lot cost down.
So trying to engineer more affordable houses from the ground up, that's a longer play.
It is. It's about how they compete if rates stay higher for longer, building that foundation for future market share.
Okay, so planning for the future. But speaking of the future, guidance. They pulled their full year guidance for 2025.
Yeah, that always gets attention.
Why'd they do it? What does that signal?
They basically said visibility is too limited right now, especially for the fourth quarter, given their spec model building homes before having a buyer and just the general market uncertainty.
Makes sense. Hard to predict Q4 in this environment.
Right. They said they'll bring back annual guidance when things feel a bit more stable, but they did give us Q3 guidance.
Okay, what are they expecting for Q3 then?
Closings between 1,100 and 1,300 homes. Average sales price between $360,000 and $365,000. So ASP slightly down from Q2.
And margins, also expecting a dip.
Yeah, slightly lower gross margins projected for Q3, 21.5% to 22.5% GAAP, or 24.0% to 25.0% adjusted. And that's explicitly because of those increased incentives they need to use to clear out that older completed inventory.
Okay, so they're being upfront, sell the inventory, even if it costs a bit on margin in Q3. Makes sense.
Yeah, SG&A expected between 15.0% and 16.0% of revenue. It's a clear trade-off.
But community count is still expected to grow into 2026.
Directionally, yes. That suggests that even with these near-term bumps and the caution, the underlying plan for expansion is still there.
Right, tactical adjustments, but the strategic growth path is still intact.
Seems so. And looking at the balance sheet, they really hammered home that deleveraging, paying down debt is absolutely a focus.
Their ratio was a bit high.
Net debt to capital hit 45.0%. That's the top end of their target range, which is 35% to 45%.
So getting that down is a priority. Makes sense with rates where they are.
Yeah. And the main way to do that is by selling that excess inventory, turning houses into cash to pay down debt.
And the share buybacks. Still happening.
They said it remains an opportunistic tool, especially because they think the stock is trading at an extraordinary discount.
Okay, so they see value, but balance sheet first.
That seems to be the message. Clear priority on financial strength right now.
So let's talk investor context. That initial pop on earnings day was strong, right? Investors liked the margin focus, the buybacks.
Definitely. A clear positive signal for the execution.
But then things got choppy in the following weeks. Analysts turned more neutral. Rates stayed high.
Exactly. And over the past year, LGIH stock has really taken a hit, down about 43% as of mid-September.
Wow, compared to the broader homebuilder ETF.
Way underperformed. ITB was down maybe 10%, XHB only down like 3% over the same period.
That really shows LGI's sensitivity, doesn't it? To rates, to affordability for that entry-level buyer.
Hugely. So the overall feeling shifted to maybe cautious constructive, like, okay, margins are better, cash returns are nice, but we're still worried about visibility and affordability.
The internal execution is good, but the external pressures are still massive.
That sums it up well.
So looking ahead, what are the key things to watch? What could actually move the needle for LGI?
Well, obviously the monthly closings numbers. That gives you the real-time pulse on demand. Any big moves in interest rates up or down will be critical. And whether they reintroduce that annual guidance, that would signal more confidence. Analyst upgrades or downgrades matter too. And look, if we actually got some sustained rate relief or saw buyer traffic really pick up again, a higher beta name like LGI focused on that entry-level market that's been hit so hard could really bounce back strongly.
Because they've lagged so much already.
Exactly. Potential for a bigger snapback.
All right, so that brings us to our not financial advice segment. Given everything we've discussed, the lag, the rate sensitivity, but also those little encouraging trends management hinted at, what's an outrageous but plausible trade idea here?
Okay, well, remember, LGI has lagged badly, mostly because of rates and affordability hitting their core buyers.
Yeah.
But management did mention things picking up a bit, end of June, early July. They tied it directly to a better rate environment. Even a temporary dip seemed to help, plus their own sales efforts.
Right, those green shoots.
So the outrageous idea hinges on this. What if that wasn't just a blip? What if demand is more elastic, more sensitive to rate drops than people think right now? If we get more hints of rates easing, even just hopes of it, LGI could re-rate significantly higher, given its focus and how much it's lagged.
Okay, so how do you play that potential upside?
The idea is go long LGIH stock, but combine it with buying a deeply out-of-the-money call option spread.
Okay, break that down.
So you own the stock for the basic upside if things improve. The call spread adds leverage, amplifying your gains if the stock really takes off, because sentiment shifts hard on rates and demand. But using a spread, instead of just buying calls outright, helps cap your cost and defines your risk on the options part. It's a bullish bet, supercharged, but with some built-in protection against losing everything on the options if you're wrong.
A leverage bet on demand snapping back harder than expected if rates cooperate.
Got it. Definitely outrageous, but plausible.
It leans into that rate sensitivity narrative turning positive for once. Okay, so wrapping things up. LGI Homes, Q2, solid quarter, definite improvement on margins, kept buying back stock. Showed discipline in a tough market.
Yeah, but they pulled the full year guidance because things are just too uncertain. Focus now is clearly on profitability, controlling costs, managing that inventory down, and strengthening the balance sheet.
The market liked the execution initially, but the bigger picture, especially interest rates, is still casting a long shadow.
Absolutely. They're navigating carefully, making the right tactical moves, it seems. But the macro environment is still the dominant factor here.
And that really sets up the key question going forward, doesn't it? Can LGI's smart moves actually let them outperform, even if rates stay challenging? Or are they just fundamentally tied to that macro cycle?
That's the multi-million-dollar question for this whole sector, isn't it?
Yeah.
Definitely something to think about as we watch the housing data roll in.
Indeed. And just a reminder, everything we've discussed here is purely for informational purposes.
That's right. It shouldn't be taken as financial advice. Always best to talk to a qualified financial professional before making any investment decisions.
Thanks for tuning in to The Deep Dive. We always appreciate hearing your thoughts on these analyses.